Good evening. We begin tonight with a developing story from the world's financial markets, where concerns are mounting over Japan's handling of its national currency and the potential ripple effects being felt across the global economic landscape. Tonight, we examine how decisions made in Tokyo regarding the Japanese yen are creating waves of uncertainty that extend far beyond the borders of the island nation, raising questions about international monetary stability and the delicate balance that governs currency markets worldwide. Japan, the world's third-largest economy, has found itself at the center of an intensifying debate over currency policy. The yen, which has long served as one of the world's major reserve currencies and a cornerstone of international trade in the Asia-Pacific region, has been subject to significant volatility in recent months. This volatility has not occurred in isolation. Rather, it appears to be connected to deliberate policy choices made by Japanese monetary authorities, choices that are now drawing scrutiny from economists, policymakers, and financial analysts around the globe. The situation we are witnessing today did not emerge overnight. It is the product of years of unconventional monetary policy, demographic challenges, and economic pressures that have placed Japan in an increasingly difficult position. For decades, the country has grappled with sluggish economic growth, an aging population, and deflationary pressures that have resisted traditional policy remedies. In response, Japanese authorities have implemented a series of extraordinary measures designed to stimulate economic activity and combat deflation. These measures have included near zero and even negative interest rates, massive bond buying programs, and direct intervention in currency markets. However, what was once viewed as a necessary response to domestic economic challenges is now being seen by many observers as a source of instability for the broader international financial system. The argument being advanced by critics is straightforward. When a major economy like Japan pursues policies that significantly weaken its currency, it does not simply affect conditions within its own borders. Instead, such policies create competitive pressures for other nations, distort trade flows, complicate monetary policy decisions elsewhere, and can contribute to broader financial market instability. To understand the current situation, it is essential to examine the mechanics of what has been taking place. The Japanese yen has experienced substantial depreciation against major currencies, most notably the United States dollar. This depreciation has been driven in large part by the divergence in monetary policy between Japan and other major economies. While central banks in the United States, Europe, and elsewhere have been raising interest rates in response to elevated inflation, the Bank of Japan has maintained its ultra-loose monetary policy stance, keeping interest rates at exceptionally low levels and continuing to purchase government bonds in massive quantities. This policy divergence has created what economists call a significant interest rate differential. When interest rates are higher in one country than another, investors have an incentive to move capital toward the higher-yielding currency, seeking better returns on their investments. As capital flows out of Japan and into countries with higher interest rates, demand for the yen decreases while demand for other currencies increases. This dynamic places downward pressure on the yen's value, causing it to weaken in foreign exchange markets. For Japan, a weaker yen carries certain advantages. A depreciated currency makes Japanese exports more competitive on the global market, as goods produced in Japan become less expensive for foreign buyers when priced in their own currencies. This can provide a boost to Japanese manufacturers and exporters, supporting economic growth and employment in export-oriented sectors. Additionally, a weaker yen increases the yen-denominated value of profits that Japanese companies earn overseas, which can improve corporate earnings and support stock prices. However, the benefits of a weaker currency come with significant costs, both domestically and internationally. For Japanese consumers, a depreciated yen makes imported goods more expensive, contributing to higher costs of living. Japan is heavily dependent on imports for energy, food, and raw materials, meaning that currency weakness translates directly into increased prices for essential goods. This import-driven inflation erodes purchasing power and can place particular hardship on households with fixed or limited incomes. From an international perspective, the concerns are different, but no less significant. When a major economy allows its currency to weaken substantially, it can trigger what is known as competitive devaluation or a currency war. Other countries may feel compelled to respond with their own measures to prevent their currencies from appreciating too much relative to the yen, as excessive currency strength can harm their own export competitiveness. This can lead to a cycle of competitive devaluations, where multiple countries simultaneously pursue weaker currencies, creating instability in foreign exchange markets and undermining the predictability that businesses and investors rely upon for planning and decision-making. Moreover, Japan's currency policies have implications for global capital flows and financial conditions. The massive bond buying programs implemented by the Bank of Japan have helped to keep Japanese government bond yields extraordinarily low, even as yields in other major markets have risen. This has contributed to complex dynamics in global bond markets, affecting everything from corporate borrowing costs to mortgage rates in countries far removed from Japan. Financial institutions that operate across borders must navigate these diverging conditions, managing currency risk and interest rate risk simultaneously, adding layers of complexity to their operations. The international financial system relies on a degree of coordination and mutual restraint among major economies. While countries retain sovereignty over their monetary policies, there is an expectation that major economies will consider the spillover effects of their policy decisions on others. International forums such as the Group of Seven and the Group of 20 provide venues for policymakers to discuss these issues and coordinate responses to shared challenges. When one major economy pursues policies that are seen as destabilizing or that impose costs on others, it can strain these cooperative frameworks and lead to tensions. In the current environment, there is growing concern that Japan's approach to managing its currency may be undermining the stability that these international frameworks are designed to preserve. Critics argue that by maintaining ultra-loose monetary policy long after other major economies have begun tightening, Japan is effectively pursuing a beggar-thy-neighbor policy, one that seeks to gain competitive advantage at the expense of trading partners. Such policies, if widely adopted, could lead to a breakdown in international economic cooperation and a return to the kind of currency conflicts that characterized earlier, more turbulent periods in economic history. It is important to note that Japanese authorities have their own perspective on these matters. From Tokyo's viewpoint, the policies being pursued are necessary responses to unique domestic circumstances. Japan's economy has struggled with deflation and weak growth for decades, challenges that have proven resistant to conventional policy tools. The aging of Japan's population creates structural headwinds for growth, as a shrinking workforce and rising social security costs place long-term pressure on public finances and economic dynamism. In this context, Japanese policymakers argue that maintaining accommodative monetary policy is essential to support economic activity, generate inflation toward target levels, and ensure that the economy does not slip back into the deflationary spiral that has plagued it in the past. Furthermore, Japanese officials contend that their policies are not specifically aimed at weakening the yen for competitive advantage. Rather, they maintain that currency movements are a natural consequence of differences in economic conditions and appropriate monetary policy responses. They point out that the Bank of Japan's mandate is to pursue price stability and support sustainable economic growth within Japan, not to target a specific exchange rate for the yen. From this perspective, the yen's weakness is an unintended side effect of necessary domestic policy measures, not a deliberate strategy to gain trade advantages. Nevertheless, the perception among many international observers is that Japan's policies are having significant spillover effects, regardless of intent. The distinction between policies that happen to weaken a currency as a side effect and policies that are designed to do so may matter less than the actual impact on global markets and other economies. What matters to trading partners and financial markets is the reality that the yen has depreciated substantially, that this depreciation affects competitive conditions in international trade, and that it contributes to volatility and uncertainty in currency markets. The debate over Japan's currency policy is unfolding against a backdrop of broader challenges facing the global economy. Inflation has emerged as a significant concern in many countries following the disruptions caused by the global pandemic and subsequent supply chain difficulties. Central banks in the United States, Europe, and elsewhere have responded by raising interest rates, seeking to cool demand and bring inflation back toward target levels. These rate increases have contributed to concerns about economic slowdown and have created challenges for financial markets, as higher borrowing costs affect everything from consumer spending to business investment. In this environment, the divergence in monetary policy between Japan and other major economies stands out sharply. While others tighten, Japan maintains its accommodative stance, creating the interest rate differentials that drive currency movements. This divergence reflects genuine differences in economic conditions. Inflation in Japan, while rising, has remained more moderate than in many other developed economies, and Japanese policymakers have been hesitant to abandon their long-standing efforts to generate sustained inflation and escape the deflationary psychology that has constrained the economy. However, this policy divergence also means that Japan is moving in the opposite direction from much of the rest of the developed world at a critical juncture. The resulting currency movements and financial market dynamics add another layer of complexity to an already challenging global economic environment. For businesses engaged in international trade, for investors managing global portfolios, and for policymakers seeking to navigate uncertain economic conditions, the volatility associated with Japan's currency policy creates additional uncertainty and risk. The situation has prompted calls from various quarters for Japan to reconsider its approach. Some economists argue that the Bank of Japan should begin normalizing its monetary policy, gradually withdrawing the extraordinary stimulus measures that have been in place for years and allowing interest rates to rise toward more normal levels. Such normalization, proponents argue, would reduce the policy divergence with other major economies, moderate yen weakness, and contribute to greater stability in international currency markets. They contend that with inflation in Japan finally rising, albeit modestly, conditions may now be appropriate for a gradual shift toward less accommodative policy. Others take a different view, arguing that premature policy tightening could jeopardize Japan's fragile economic recovery and risk a return to deflation. They point to the structural challenges facing the Japanese economy, including demographic decline and high public debt, as factors that require continued policy support. From this perspective, Japan's current approach, while creating international tensions, remains necessary for domestic stability, and the burden should be on other countries to accommodate Japan's circumstances, rather than expecting Tokyo to change course. This disagreement reflects broader questions about the international monetary system and the responsibilities of major economies within it. To what extent should countries coordinate their monetary policies? How much weight should policymakers give to international spillover effects versus domestic policy objectives? When do legitimate domestic policy choices become problematic from a global perspective? These questions have no simple answers, but they have become increasingly urgent as the divergence between Japan and other major economies has widened. The historical context adds further dimension to these debates. The international community has experience with currency conflicts and competitive devaluations from earlier periods, most notably during the 1930s, when such policies contributed to the deepening of the Great Depression and the breakdown of international economic cooperation. The lessons learned from that experience helped shape the post-World War II international monetary system, which was built on principles of cooperation, coordination, and mutual restraint in currency matters. While the specific mechanisms have evolved over time, moving from fixed exchange rates to floating rates, the underlying principle that major economies should avoid policies that deliberately destabilize currencies has endured. Whether Japan's current policies violate this principle is a matter of debate, but the concern is clear. When a major economy's currency moves sharply, whether by design or as a consequence of domestic policy choices, it affects everyone else in the interconnected global economy. The question facing policymakers today is how to balance legitimate domestic policy needs with the collective interest in maintaining stable and predictable international financial conditions. As we continue to follow this story in the coming weeks and months, several factors will be crucial to watch. First, how will other major economies respond to yen weakness? Will we see coordinated interventions in currency markets, or will individual countries take their own measures to address competitive pressures? Second, how will the Bank of Japan navigate the tension between its domestic mandate and international concerns? Will pressure from abroad influence policy decisions in Tokyo, or will Japanese authorities maintain their current course regardless of external criticism? Third, what will be the broader impact on global financial markets and economic stability? Will currency volatility remain contained, or will it escalate in ways that create more serious disruptions? These questions do not have clear answers at present, but they will shape the economic landscape in the months ahead. What is clear is that Japan's currency policies have moved from being primarily a domestic concern to becoming a matter of international significance. The decisions made in Tokyo are reverberating through foreign exchange markets, affecting trade flows, influencing monetary policy deliberations in other capitals, and contributing to the complex set of challenges facing the global economy. Tonight we have laid out the essential elements of this unfolding story, explaining how Japan's approach to managing its currency has raised concerns about global stability, examining the mechanics of currency movements and policy divergence, and exploring the competing perspectives on what should be done. This is a story about the intersection of domestic economic policy and international responsibility, about the challenges of coordination in a world of sovereign nations with different circumstances, and about the fragility of the international economic order when major players move in different directions. As events continue to develop, we will bring you further updates and analysis, helping you understand the implications of these currency battles for the broader world economy and for international stability.